everyone. My name is Amanda Lake, and I'm a marketing specialist at Genscape. Thank you for joining today's webinar. We're just going to wait a few minutes for people to sign in. Thank you. Hi everyone, thank you for joining our webinar today, Disruption in the Oil Market Supply Chain and Impact on Prices, Genscape's Real-Time Refinery Data on Thomson Reuters Eikon. Our speakers today will be Brian Bush, Director of Oil Market Business Development for Genscape, Waji Choudhury, Senior Analyst Oil and Swaps at Thomson Reuters, and Krista Kuhl, Senior Analyst Gasoline, Thomson Reuters. If you have any questions, please put them in the box below your slides on your screen, and we'll answer them at the end. I'm going to pass it off to Krista to start.
Thanks, Amanda. Hi everyone. I'll be highlighting Thomson Reuters Research and Forecast latest U.S. monthly refining report. The report can be found on the Eikon platform on the Global Crude Oil homepage, and it's located in the Documents area on the right-hand side of the page under the Monthly and Special Reports section. Also, if you're interested in the report, please feel free to send me an email after the webinar, and I'll send you information on how to sign up for email notifications when it's released each month. So this is a report that we've been publishing since early this year, and it covers major refined product yields for the East Coast, Gulf Coast, and West Coast of the U.S. So to calculate these yields for our monthly report, we use a database of primary and secondary refinery unit capacities, as well as a database of over 150 global crude oil assays. Waterborne imports from the Thomson Reuters trade flows data is used to calculate imported crude grades, and domestic crude grades are assigned based on historical volumes and regional government data. The model is configured for the selected region with the refinery capacities pulled in, and then the crude slate for the month for both domestic and imported crudes as input. The model then calculates the major refined product yield based upon the given input. So I'm going to go over our latest report and what it covers. So for the East Coast PADD 1, according to the Energy Information Administration's weekly data, crude runs on the East Coast remained flat in October. September crude runs and October crude runs were about 1.1 million barrels per day. The drop in runs in September was primarily due to refinery maintenance that we saw at PBF Energy's Delaware City refinery, and as the units have come back online in early October, runs are expected to increase going forward. On the right-hand side chart, it shows Thomson Reuters trade flows data, which shows that waterborne crude imports in September and October averaged 667,000 barrels per day and 591,000 barrels per day, respectively. With domestic crudes keeping the region well supplied, imported crudes in the East Coast have remained lower this year than last year. The drop in imported crudes has primarily impacted light crude imports, as increased domestic crudes moving into the region are of light grade. The East Coast has seen gains in medium crude imports, with the largest volumes being Vasconia and Arab medium, while heavy crude imports have seen minor losses in recent months. And on to the yields. LPG and still gas yields in PADD 1 have followed seasonal trends throughout the year, and we expect them to continue to remain near the 5-year average going forward, with September and October's yields mirroring those seen last year at 5.6 and 5.5% respectively. Gasoline yields for the East Coast fell from previous year-on-year highs seen during the first half of the year to near the 5-year average in August. We anticipate this trend to continue in September and October, with gasoline yields remaining below last year's levels at 46.2 and 46.4%. There have been interesting changes in jet and diesel yields on the East Coast lately. The refiners on the East Coast began prioritizing jet yields over diesel yields beginning in Q2 2014, and this trend continued throughout last year into early 2015 with record high jet yields in the region. However, refiners in PADD 1 lowered their jet yields in June from the previous record highs in lieu of diesel. This continued in August, and we expect it to remain in September and October, with yields at about 7.3% for jet. Those East Coast refiners have increased their diesel yields in recent months to bring up the yield to the 5-year average from near the 5-year minimum. We expect yields in September and October to be around 30%. As a result of the higher distillate yields, stocks are well supplied in the region heading into winter demand. Fuel oil yields in PADD 1 have typically been well below the 5-year average, and last year's levels throughout this year thanks to lower heavy crude imports and increased light crude supply. Yields have leveled off in recent months to between the 5-year average and 5-year minimum and are forecast at 4.7% for September and October. Petcoke yields in PADD 1 have remained relatively unchanged throughout the year, staying around the 5-year average, and are expected to average about 3% for September and October. And now we move on to the U.S. Gulf Coast. Crude runs have fallen in recent months on the U.S. Gulf Coast from the elevated levels seen in late Q2 and Q3, but October's levels remain above those seen last year. We anticipate waterborne crude imports into the Gulf Coast for September and October to be 2.8 and 2.9 million barrels per day respectively. In October, Gulf Coast crude imports were flat year-on-year after months of previous year-on-year losses. Waterborne crude imports have steadily fallen in the region as they have been replaced by increased domestic supply. As usual, heavy Mexican crude Maya made up the bulk of imports in October at about 560,000 barrels per day, with medium-grade Arab medium coming in second at just under 300,000 barrels per day. For the Gulf Coast, LPG and still gas yields have been lower year-on-year, but showed some strength in August, remaining near last year's levels. The yield will fall seasonally in the coming months, with September and October's yield expected to remain near 8.8%. The gasoline yield in PADD 3 jumped in August to above the 5-year max, and we anticipate it to remain above the 5-year average in September and October at 42.5 and 43.3% respectively. Jet yields have been varied this year on the Gulf Coast, oscillating between the 5-year min and 5-year max. For September and October, we anticipate jet yields to remain near last year's levels at the 5-year average at 9 and 9.2%. Diesel yields in PADD 3 have been increasing since 2010, the current 5-year minimum, and we anticipate yields to remain just under last year's levels at 31.8 and 31% for September and October. Fuel oil yields in PADD 3 have remained near the 5-year minimum for the past 2 years thanks to the increased volumes of light domestic crude being run in the region, and we expect this to continue in September and October, with yields remaining near 2%. Petroleum coke yields too have remained lower, with yields remaining below last year's levels throughout much of 2015. We anticipate this to continue in September and October with yields at 5.5 and 5.8% respectively. Now on to the West Coast. West Coast crude runs jumped in Q3 of this year to well above last year's levels, but have since fallen off in October. Crude runs for the region averaged 2.6 and 2.5 million barrels per day respectively for September and October. Despite the drop-off in October, crude runs in the region remained well above last year's levels, if not by as much seen in previous months. Minimal crude unit maintenance is planned in the fourth quarter in the region, so we anticipate crude runs to remain above last year's levels. We expect crude imports for PADD 5 in September and October to be 1.1 million barrels per day for both months. Import levels are on par with those seen last year during the month, with Arab Light from the Middle East and Oriente from Latin America being the two largest imported grades. LPG and still gas yields on the West Coast were lower earlier this year, but have since risen to the typical 5-year average level, and we anticipate them to keep this track through year-end and average 8.2% in September and 6.8% in October. We expect gasoline yields on the West Coast for September and October to average 45.8% and 46.4% respectively. Gasoline yields remain flat in the region as the area has about a quarter of its FCC capacity down for planned maintenance currently. As the units are not planned to come up for maintenance until later this year, the yields are likely to remain below average. Jet yields in PADD 5 have typically remained above the 5-year average for most of the year. We expect this to continue in September and October, with the yields staying near an average of 17%. Diesel yields have remained high this year as well, but did not surpass the highs seen in February and March of last year. Yields for September and October are expected to be higher year on year at near 23%. Fuel oil yields in PADD 5 have tracked to just below last year's levels through most of 2015, and we expect this to continue in September and October, with yields averaging 4.6%. Petroleum coke yields in the region remain flat for several months, but we expect them to remain below last year's levels in September and October, with yields averaging 6.1% and 5.9% respectively. And now I'm going to pass it over to my colleague, Waji Chowdhury.
Hi, good afternoon, everyone. This is Waji Chowdhury. I cover oil futures and some trade flows over with Thomson Reuters. I published a report in the middle of the month detailing PADD-level refinery margins. It's available on the oil homepage on Eikon on the right section under monthly reports. Again, it comes out in the middle of the month. Krista's report comes out in the early part of the month. So in this portion of the presentation, I'm going to aim to shed more light on refinery margins by calculating cracks in a more practical way. It's important to factor in when the crude is bought and arrives into the refinery, as well as when it's run, followed by when the refinery markets the refined products. Now, the computations of cracks are done in a more realistic fashion to match refined products against crudes run in September and October. That's what the latest report covered. The margins calculations utilize yields from Krista's model. We just spoke about that, based on an analysis of Thomson Reuters trade flows data on U.S. crude imports and historical domestic crude slates. Krista estimated the crudes run at refineries in PADDs 1, 3, and 5 for September and October. The model takes into account refinery configurations in these regions and uses these configurations along with the region's crude slate to calculate various product yields. Okay. So basically, margins are calculated considering two things. Simplistically, when the crude is bought and arrives to the refinery and run, versus when the refined products are actually output. So you have domestic crudes and imported crudes. I'm going to start off talking about imported crudes. The average price of refined products were compared against the average price of a 7-day period prior to the departure of the crude coming to a port in September and October. So, for example, if a Venezuelan crude grade, you can take Marais or a diluted crude oil, arrived in Houston on September 25th, I'm going to look at the prices between September 14 through 20. So again, it's coming into port on the 25th. 5 days to ship it, so you got a 7-day window before that. 14 to 20, take an average price of that, and that's how I am pricing the crude in a very crude manner. Now, for a domestic crude grade, it's going to be a lot more different. You have pipeline schedules. I utilize something called trade and run month margins and calculations. So for crudes run in September, The prices between July 26th and August 25th were utilized for the spot prices, and for crude grades in October that were run, the trade month would be August 26th to September 25th. This is right here just a snapshot of a part of my model. You can see the month, the arrival date, the load port, and the discharge port, and the grade. You can see the ship time is integrated, and the barrels per day. These are all trade flows data. Just wanted to give you an example of how, prices are computed. Now, on the refined product side, so we talked about the crude. Now, I'm going to pit the refined products pricing against the crude purchasing costs. Now, when a barrel of crude goes out, the general rule of thumb, according to my research, is gasoline is output about a week after the crude is run. The rest of the barrel, you have exceptions here and there, but on average it comes out 2 weeks after the crude is run. So, for example, the prices of gasoline in those regions, New York Harbor, Gulf Coast, and LA, for the crude that was input in September, we're going to look at data points from September 9th to October 7th. And for October crude runs, gasoline data was averaged from October 8th to November 6th. The remainder of the barrel, again, the items come out about 2 weeks after crude is run. You have the midpoint of the months, basically. This portion is to describe how the splits are done. As we know, the EIA puts out data on diesel splits, fuel oil splits, and LPG splits. I did an analysis of the data for the last 12 months. Okay, so the Gulf Coast, there's a 90-10 split. New York Harbor, it used to be 90-10. It's become more and more an 88-12 split. LA, it's 95-5. Fuel oil, it's 90-10. New York Harbor and LA, it's a bit more different. The LPGs, there's a propylene-propane split. There's an isobutane and a butane split as well. And those numbers, you pit them against what Krista's yields model puts out, and we get the margins that way. So on to the next slide. These are the refined product prices for PAD 1 and the gross yields and margins. So as you can see, the October gross refinery margin for PAD 1, according to my analysis, will be roughly $9 a barrel. Again, this doesn't take into account freight costs and time value of money. This is a pure comparison between crude put in and the cost of refined products that are going out. And the September margin was above $13 a barrel. This is a big drop. It's sort of been a double whammy. As you can see, the refined product yield came off $1.75 approximately, and the crude input costs went up from September to October, roughly $2.50. That explains the big drop right there. Not a good month for refining in October, but still, these are okay margins. Again, the yields are from Chris's analysis. Not on the slide. I wanted to share some of the crude grades that are very popular. In September, the most popular crude grade was, you can guess, it's Bakken. Roughly 40% of the crude slate was that. You have some Canadian grades, Cold Lake and White Rose. That's about 10%. Hibernia, 12% by itself. And you have Mexican crude grade Isthmus, roughly 4.5%, and Adoba crude oil from West Africa. It's pumped from Chad into Cameroon through a pipeline, roughly 6% there. And in October, Arab medium made up roughly 3.5%, Adoba 4.5%, Hibernia, it came off from 12% to about 6.5% for Hibernia. And Hungo blend took a dip up to about 5%. Vasconia was about 12%. And again, Bakken was roughly 40% of the crudes run. Moving on to the Gulf Coast, the margins there also came off, similar to PADD 1. However, the crude input costs did not rise as much. The oil complex came off between September and October, and that's largely reflective of that. And the October gross refinery margin was $6.97 in October. September was $9.70. Among the crudes that are popular and run that month, in September you have roughly 5% of the crude runs Arab medium, diluted crude oil 4.5%, Maya 6%, WTI 14.5%, Eagle Ford about a sixth of the crude slate, Bakken 8.7%, and West Texas sour a little over 10%. In October, one of the more popular crudes run, coming in at 3.5%, was about Arab medium, Maya just under 7%, WTI about a sixth of the slate, Eagle Ford 15%, Bakken right under 9%, and West Texas sour just under 11%. Gulf Coast, relative to PADD 1, has a lot more diverse crude mix in terms of domestic and imported. Moving on to the Los Angeles area. Krista does split out internally the PADD 5 regions. I just wanted to focus our attention on the Los Angeles area. In the report, I do split out Los Angeles, San Francisco area margins. They're very similar, so I thought I would pick the LA area. Now, contrary to how the rest of the country has been doing in PADD 1 and PADD 3, for example, the margins were pretty sticky September to October. Refined product prices have been extremely high due to refinery issues in the Los Angeles area. $16.85 was my October gross margin estimate. September, the final estimate was $16.69. The crude slate is a little bit less diverse than the Gulf Coast and Atlantic Coast, but Arab Light, Arab Medium made up about a little under 13% of the crude runs. Ciba, under 7%. Oriente, roughly 11%. And Simric, 5.8%. South Belridge, 8.1%. These are both domestic grids. And ANS, about a fifth of the crude runs. Going into October, ANS was about a fourth of the crude runs. Arab Light went up a little to just under 7%. Napo was 10% of the runs. South Belridge was about 7.5%. In my next slide, I wanted to give you a view on these are prices as of this past Friday. I just want to give you a view of the futures, what they're showing. These 3-2-1 cracks, you have the Gulf Coast, New York Harbor, and LA. Right now, it's going to get weaker. So you have the spot versus the November crudes, swaps, and so on and so forth. It's rather weak. It strengthens right around end of Q1, reaches a peak in the middle of Q2. So the refineries, they are coming off of maintenance now. In the West Coast, you may have some maintenance early in Q1, but the best time, according to these curves, the best time to refine would be right around April of next year. Again, these are futures prices. They are subject to change, geopolitical events, but it looks like the best refinery margins are going to be in April, which is surprising because we figure the summer refinery margins are going to be running really, really hard. But that is my portion of the presentation. I'm going to pass it on to Brian. Thanks.
Thank you. I want to say thank you to our friends at Thomson Reuters. We have very much enjoyed partnering with them. I've enjoyed listening to Wajid and Krista today, but we've been partnering now with Thomson Reuters for quite a while. For those of you who don't already know it, we have an exclusive agreement that we deliver our refinery outage alerts or refinery interruption alerts exclusively through the Reuters Eikon platform. Within that, we currently monitor 93 refineries around the globe on a daily basis as they operate. We do this primarily through thermal imagery, and we look at how particular units are running. In the past year, we've added significantly to that slate of refineries. Within Pad 3, primarily along the Texas coast, we've added 12 new refineries, 3 to Canada, 2 to Pad 2, and 1 to Pad 5. The way we monitor that refinery and how that helps and actually goes hand in hand with the data you've seen today from Reuters is providing real-time information as refineries have upsets. Those refineries flare when that happens, and we report it as soon as we can verify that this is not just a typical upset. So Reuters carries that real time to all of their customers. In total, we currently monitor almost a little over 400 particular units, with each unit representing a CDU, a VDU, an FCC unit. And with the addition of 5 new refineries that are going to come on very soon in Pad 5, we'll be well over 450 particular units. Within that, let's take a look at just how detailed our coverage is across the U.S. Within Pad 1, we currently monitor over 90% of the refining processes that you find there. In Pad 3, with the additions this past year, our coverage there has also gone above 90%. We've got 80% of the refinery operations within Pad 2. That is the bulk of the refining operations within the U.S. We have lesser coverage in Pads 5 and Pads 4. Although we are building in Pad 5, and we have particularly targeted the West Coast because of the significance of those refineries, that they are what is producing the gasoline required for the West Coast. So as we've seen this past year, any upset of refining operations within California can have a significant impact on gasoline there, more so than the same type of interruption in a Pad 2 or Pad 3 refinery, because there is excess capacity in those other locations. So if you look overall, we now cover well over 70% of the refining operations with real-time coverage, all delivered on Reuters Eikon platform. An example of how that can impact the market and how it can be very significant is if we go back and look at what took place at the Whiting Refinery back in August 9th. That was on a Sunday, and the new Pipe Steel 12 shut down during that Sunday. Pipe Steel 12, of course, is the new very large CDU, VDU coker train that was put together in the last big turnaround at Whiting. We reported on that through Eikon on that Sunday, and along with that, you can see exactly what took place as everybody came in on Monday and realized that a significant source of Midwest gasoline, also a draw on WTI and Canadian crude, particularly West Canadian Select, was now going offline, and it could have been offline for a significant period of time. There were immediate reactions in the product prices in the Midwest. It also had an impact on the price of WTI, and it impacted prices in New York Harbor. So alerting on those refineries can have very important impacts. Now, in addition to reporting on the refineries, the other thing that Genscape does and reports on that goes hand in hand with the two Reuters reports we discussed earlier today is the monitoring of inventories in New York Harbor. And if we look at what's been going on in the harbor, we have seen gasoline stocks and heating oil stocks build to where we saw them reach all-time records on November the 2nd. In the last couple of weeks, we have seen stocks start to fall off a little bit, but year on year, we're still at record high inventories. This is not only affecting New York Harbor and that market, but it is having a global impact in that we've seen production within Northwest Europe, which oftentimes comes into the harbor and is imported. Those imports to the U.S., those exports from Europe to the U.S., have significantly fallen off. And you can see where all of that production that normally has been going east or coming west to the U.S. has been going east of the Suez, primarily into Singapore. So we have seen a significant change in the direction of exports of products out of Europe as we've seen the U.S. stocks start to fill up. You can see that not only have gasoline stocks hit high, but we've seen record highs in heating oil stocks. And if you look at the forecast for a fairly mild winter, those high inventories may not bode well for the price of heating oil going forward and for refinery cracks up in that area. That is kind of what we do that specifically supports refined products and things that complement the crack spread reports and the utilization reports. So in addition to that, though, we do significant work with Reuters. It is the one platform that actually covers everything Genscape does. So I'd like to take just a few minutes and go over what Genscape produces, how we do it, and where it's available on the Reuters platform. So what we do, or what Reuters does, really, within the whole Eikon platform, is providing a workflow view of oil flows via water pipeline, refinery assessments, including our real-time monitoring, as well as price assessments that go with that. So you can take all of that data and hand in hand pull that together into your analysis right on your Reuters screen. So if we look at the roadmap of what Genscape supplies to Reuters, we're going to start out looking at our Spring Rock production forecast. That is our U.S. crude oil forecast. We also do pipeline monitoring, Mid-Con St. James. We do crude oil storage across the U.S. and Canada. We do the refinery monitoring, and then we also do vessel tracking through our vessel tracker subsidiary, and all of that's delivered within the Eikon platform. So if you look at what we do in production forecast, we look at individual wells, those currently drilled, what the life cycle and the yield curve on those wells look like, as well as additional and new wells being drilled, the location of those wells in relationship to the sweet spot of the formation and that which might be an outlying area. All of this can be brought into the Eikon platform, and from there you can see by particular field. So you're not just looking at the production by pad, but you can actually get into the individual formations and look at the real production throughout history, as well as our forecast by each of those various formations. Now, the flagship of Genscape products over the years has been our Cushing inventory and the associated Mid-Con pipeline product that flows in and out. We currently see approximately 86 million barrels of storage capacity at Cushing, Oklahoma. Currently, that storage is close to 67% utilized. If you look at the pipeline capacity, we monitor almost 96% of the pipeline capacity coming into Cushing and 87% of the takeaway capacity leaving Cushing. Now that's changed significantly over the last 15 months. We've seen almost 3 million barrels of total pipeline capacity added both in and out of Cushing, Oklahoma. It was quite a rush over the last year to bring all of those pipelines online, but we are currently monitoring Flanagan South, Pony Express, the Trans-Canada South leg, both the Seaway and the Seaway Twin, the enhancements to White Cliffs, Glass Mountain. All of those have been incorporated in, so we have the bulk of the crude coming in that can actually be viewed on a 30-minute basis. It's a near real-time calculation of pipeline flows in and out of Cushing, and then twice weekly we take a physical measurement using thermal resolution and high-resolution photography. Within the Eikon platform, you can pull all of that together, and you can see the total stocks that we measure, both at Cushing, U.S. Gulf Coast, and you can see from the screen here, these are total stocks within the U.S. and Canada and the levels, how they've moved over time. You can see the big buildup that we saw from November all the way through April in Cushing as we had significant contango in the market. And 12-month to 18-month storage economics were very easy things to do at that time. And we saw crude bought and put into every single tank that you could get your hands on in Cushing. We've seen that come down slightly, and then over the last couple of months, the build has started again as we've got into truly cash and carry economics on the front end of the price curve. You can also look at a particular storage and compare that with the prices that you're bringing in from your other price services within Eikon. So in this particular slide, we're looking at what has happened to Canada storage over time and the impact that's had on the price of WCS, the basis price. So you can see that there are times when you have trends in storage that absolutely are reflected in a relationship to the trends that you see with the price differential to WCS. So being able to lay our physical fundamental data over with the real-time price data allows you to do real-time analysis of this is what the market impact could do. Our alerts come in, and our pipeline alerts identify by pipeline when there has been a disruption that is outside of normal operating activity. When we see certain pipelines go down, we may not alert on that immediately. There's always a delay to take a look and determine, is this a significant disruption or is this just a pause while they're changing and switching batches over? Some pipelines, we expect to see them go down on a regular basis, come back up 15 to 30 minutes later. Other pipelines, they run constantly. So anytime we see a disruption in those pipelines, it gets our attention. We evaluate it, put that out, and you have an option on those alerts how you want to see them. They can either pop up on your screen or you can set them so that they get delivered to you via email. You have your choice that's configurable within the pipeline. You can even go out and identify what pipelines are important to you so that you know what you wanted to be alerted on, and you can filter out other pipelines that you think are not going to have the market impact. So it gives you the flexibility of knowing when something needs your attention that you believe may have an impact on the market, and you may need to take some type of immediate action. The same thing is true for our refinery alerts, where you can identify and customize those alerts and how you want them delivered, either within your platform or delivered to you via email. Now, we do monitor things other than just the crude storage and outside of the U.S. We have recently started monitoring the product storage and crude storage at ARA. That product is now about 2 years old. You can go back and compare some of that to the IEA numbers, and find out that we've got very good at tracking product stocks and crude stocks. Our interest in that particular product has grown significantly in the last 6 months. We've seen a real relationship to some of those activities as we've seen that storage fill up just like we have seen the storage in New York Harbor fill up. And you can look and see when we see those prices in backwardation, when we've seen a contango market enter in, and what the relative storage at ARA during those time periods have been. So there's definitely a relationship that people have identified, and they've started paying more attention to it. And to complete that picture of the North Sea and the arb that can exist between exporting heating oil, gas oil over to Europe. Europe at times have exported gasoline back. We also monitor products in the New York Harbor. Total all, we monitor over 99% of the total storage capacity that's available for delivery against the New York Harbor contracts. That totals almost 36% of the total storage within Pad 1B. That, again, is a weekly storage report that comes out and is available so that as soon as we release it, it can be immediately available for you on the Reuters Eikon platform. It's a great tool to use. It's something that is available to you. If you are a Genscape customer, there's no additional cost to having it delivered on Reuters Eikon, but it does deliver some very powerful tools to you. And we look forward to truly continuing our partnership with Reuters in the future and delivering even more tools that will let you react quickly to market activities. So I'm going to turn this back over to Amanda for any questions.
Okay, everyone, so if you have any questions, please submit them in the questions box under your slides. We have a few already, so this one is for Krista. Do the yields vary from summer to winter, accounting for additional butane blending in the winter versus summer?
Yes, Amanda, we do in the model take into account summer and winter variances, so we do take that into consideration.
All right. And this one is for Brian Bush from Genscape. Will you monitor Line 9 in Southern Access Pipeline?
Yes, we will be monitoring Line 9. In fact, we've got monitors already on that pipeline with 3 more expected to be delivered. We've been watching Line 9 as line fill has occurred, and we're anticipating by the end of this month for it to be in production operation.
Okay, and another one for Brian. Based on your monitored refineries, how much capacity is still in maintenance that could come back online soon?
Well, over the last 2 months, we've actually monitored a little over 2 million barrels of primary crude processing capacity go offline for maintenance. Most of that has come back online. Certainly we see Catlettsburg restarting currently. That's their largest crude unit at that 242,000 barrel a day refinery. So it's coming up right now. We also see Robinson starting to come back up. The FCC at Galveston is starting to come back up. Total all, we probably see within the next 2 weeks another probably 350,000 barrels of capacity in Pad 2 and another 100,000 barrels in Pad 3.
Okay. This one's for Waji from Thomson Reuters. Where do you see refinery margins going in the Gulf Coast for the month of November?
Fair question. You have to bear in mind that a lot of the demand has been coming off since the summer. This has led to a drop in the refined products prices on top of the declining crude oil complex, WTI and Brent coming off. If you look at M1 gasoline, the paper, right now it's M4 in spot, but in paper it's M1. Last trade I saw was 11 under the January NYMEX. right now you're seeing spot prices right around 10-ish. So that's going to come off. I expect the crude complex to continue to stay right where we are to a more downward momentum. I don't think it's going to go back up unless there's a happy Christmas rally or a big geopolitical risk premium. But the demand's going to continue to come off. OPEC's going to meet in early December, and that they're not going to change policy. OPEC has a history of being stubborn with their production rates. All in all, I think I can talk about 3-2-1 crack. I don't have a terrible amount of knowledge on the yields. When Krista's yields come out, we will be working on a forward yields model in the next quarter, quarter 1 of 16. But the 3-2-1 crack, on my sheet, I'm seeing it in the 750s, and going into the month of December, it comes off to the upper fives. So the cracks are looking weaker and weaker against Brent. Same with TI. You're looking at roughly in the early 10s to early 8s for that. So that's the long-winded answer to that question.
Okay, I think that concludes today's webinar. Thank you everyone for joining. We'll send the slides out by tomorrow. Thank you.